What is the money supply? Fellow Toastmasters, welcome guests. When you hear on TV or on economic news or CNBC, the money supply, does anyone have any opinion what that is? Okay.
Isn't all the money in circulation, not just cash, but just everything out there at one given time is being
Yes.
passed around?
Yes.
Unfortunately, not enough is coming to me.
I'm going to explain an example of how the money supply expanding, contracting, and how it actually impacts us on a very local level. So, Israel, for example, buys a computer and he figures out how to start printing $100 bills. He's really good, no one can detect him. The FBI's not onto him yet. So he goes ahead, he prints off $2 million in $100 bills, and he has this money. He needs to do something with this money. So he decides to start a business. He goes ahead and needs a realtor to find a location to put this property. So he calls up Bernard. Bernard finds him the best commercial spot, and he buys this amazing warehouse in this great location. So you can see right there, the money supply, which he created in his computer, just helped the real estate market. It then gave Bernard commission for selling the property, so now he has more money in his pocket. So Israel decides to set up a shop making fancy belts and shirts and shoes. So the way you do this is you have to buy all this equipment. So that money that he printed on his computer, which he increased the money supply, then goes to our manufacturing sector. So all of that money is now being spent on goods. And he needs to hire people to work in the factory. So now he employs about 10 to 15 people in his factory. Now, he's the money supply, helped the real estate market, he gave people jobs, helped our manufacturing economy, and it just also creates competition for the shirt, shoes, belt store across the street. So it helps the consumer in that way. Now, the FBI figures him out. The FBI is really angry that someone's creating money. The Federal Reserve is really upset. They come in and they just shut him down. They take all that money, lays off people. The money supply just shrunk. The factory has to be sold, liquidated, sell all the equipment. You have to put the property on the market to repay the stolen goods. So right there, it hurts the economy. The money leaving the money supply hurts the real estate market. People get laid off. And that's one gist of it. That's how the money supply increases and helps the economy. And on the flip side, it hurts the economy. So the Federal Reserve talks about increasing interest rates and decreasing interest rates. And a lot of people, that's just noise. It doesn't really mean anything. So the Federal Reserve was supposed to increase rates 1% this year. What that means is 1% more expensive to borrow money. Now, if we were going to buy a house and it's 3% for our mortgage payment, now it's 4%, the same salary, we could afford less house, which puts pressure on the housing, so the houses don't appreciate, they'll actually start depreciating, or at least it impacts the demand that way. Also, 1%, if a business wants to take out a loan and they're figuring their balance sheet, it's now more expensive to borrow money because it'll cost them more in interest payments per year. So it's more expensive. This contracts, this takes money out of the economy. On the flip side, if rates go down, if right now a mortgage is at 4%, say a mortgage goes down 2%. This means there's what's called easy money. There's more money in the economy because we could go farther with borrowing money. So for example, if you could afford a $100,000 home with a 4% interest rate, you can now afford a $200,000 home with the same exact finances. All this is increasing the money supply versus decreasing the money supply. Another way they increase and decrease the money supply is something called the reserve requirement. for a bank. Banks have to keep in 1/10 of the reserves. What I mean by that is, if $1 million goes in, they need to hold 100,000 of that in reserves. Then they lend out 900,000, then 900,000 goes back in. For that, they have to keep in 10%. So when they change the reserve requirements, that also changes and impacts how much money is in the supply versus how much money is not in the economy. And that is it's a very easy way to manipulate the economy. So right now we've got 2 people running for president. We've had presidents in our past, and we give all the credit, the economy, to the president, who's not the president, who's going to be the president of the economy. And they really have nothing to do with the economy. They have very little. Sometimes they can push an agenda, push a stimulus, but that does temporarily increase the money supply. When they push stimulus and they put a certain amount of money in everyone's pocket. But really it's the Federal Reserve that puts big policies, big money policies in place. They either put money in, take money out, and just to pay attention to the Federal Reserve, because that's why the economy expands and contracts. It's not because of the president. Presidents really don't have any major role at all. So next time you're wondering why the economy is doing well, look at the Federal Reserve, look what they're doing. It's really boring, but in reality, that's how you know what's going to happen. Fellow Toastmasters.